Hi students, so let us look at profitability ratios. So we have to learn about four type of profitability ratios. The first one is gross profit margin, second one is operating profit margin, the third one being ROC, and the fourth one is asset turnover. So let's start with gross profit margin. Gross profit margin shows what percentage of gross profit is made out of the revenue generated. So gross profit is the difference between direct income and direct expense, indicates the direct profit, that is the margin which has been charged. So during a ratio analysis, when you see that the gross profit is increasing, it is a good sign because you are making more margins. But your gross profit, the reasons behind the increase of your gross profit can be two things. Either you have increased your margin so that you can make more margin, okay, or else it may be due to lower cost of sales. That is, your cost of sales is decreasing, maybe due to efficiencies in your production lineup, or your achieved economies of scale, or you have bought in a new technology which reduces the cost of the product. So these may be the reasons for increase reduction in your cost of sales and increase in gross profit, or else it would be the reason that you have increased your margin. The thing about reduction in this gross profit margin is that there are two reasons for that also. Either you have reduced your margins. Now, why would you reduce your margins? So if you reduce your margins, automatically your selling price gets reduced. So if your selling price gets reduced, there is a chance that your demand will get increased. So if your demand increases, you can make more sales. So sometimes companies purposefully reduce their margins to keep their selling price low so that they can sell more units. So you have to check with your revenue whether your revenue is increasing when your gross profit margin is going down. Stating that, you can say that okay, we have put our gross profit margin down so that we could make more sales. Or else, when does your gross profit margin go down? See, your revenues every year can increase. In the same way, your cost of sales should also increase. The gap should be same. But what if your cost of sales start increasing in a rapid rate? The gap reduces. That is, the margin reduces. This may be due to inefficiencies in the production processes, or due to some what do you say, situations like underlying situations like recession or COVID, or what do you say, war, whereby your raw material costs and everything increases. So those situations can also affect your gross profit margin. So you have to analyze whether your gross profit has increased or decreased. If your gross profit has increased, then you have to look into whether there were any new technologies used, or whether we had made more production so that we reach economies of scale, or look into more efficient processes. Is there any mentioning about those things? Or the next thing is that you could say that we have increased the gross profit margin. Then if your gross profit margin has decreased, look into reasons like whether we have more revenue, whether we have produced more, whether our production is more, whether our asset turnover ratio has increased. So all this contribute to saying that you have reduced your gross profit margin to make up more sales. Okay, so that would be one reason which you have to look into. Or look into reasons whereby there were inefficiencies in the company which might have caused your cost of sales to increase, or the old supplier is no more supplying us with at the same rate, they have changed the rates, or we have negotiated with our old suppliers, but the new rates are much more higher. So these might be the reasons whereby your cost of sales increases and automatically your gross profit ratio goes down. Okay, and looking at the next ratio, that is operating profit margin. See, to understand how much margin we are achieving, so over here it shows what percentage of net profit is made out of revenue generated and control over other expenses. The second part is the main thing over here, control over other expenses. Why? Because the margin in gross profit margin ratio itself, we are looking at how much margin we are able to generate out of revenue. So your gross profit and net profit are different only because of certain things which come in between them. Those are operating expenses or other expenses. So when these expenses are on a higher rate, then automatically your net profit ratio falls down. So you have to check the gap between the gross profit ratio and the net profit ratio. So whenever you're taking up operating profit margin and you're explaining it in your ratio analysis, the first thing that should go to your mind is if your gross profit ratio has fallen down, automatically your net profit ratio will fall down. If your gross profit ratio has increased, automatically your net profit ratio will increase. So directly you can compare that, and then you have to look into the gap. So if the gap is low, that is, if gross profit ratio and net profit ratios gap is low, then we can say that the company has more control over its operating expenses, because if the gap is low, then the operating expenses are low. If the gap is high, then you have to say that we have less control over our operating expenses. Now, directly talking about the control, we have to also look into whether there are any other incomes that only occur for this particular year. For example, if you have sold a non-current asset and you have got a profit on that, then that profit will be included in P&L and it will reduce your operating expenses. So it will be netted off with your operating expenses. So your operating expenses might look smaller, which shows that you have control, but in real case you don't have control. It was because of the profit from the sale of non-current asset, or if you have profit from discontinued operations. So all these things will affect your operating profit margin. So first thing what you'll write is you'll always go by writing whereby if your gross profit ratio is low, your net profit will be low. Your gross profit is high, your net profit will be high. This is the first point. The second point will be talking about the gap, whereby you'll talk about do we have more control or do we have less control. And the last point that you will be talking about will be on why is your operating expenses low? Is it because of a new, what do you say, income which is generated from sale of non-current asset or from a discontinued operation? If that is the case, then you have to say that it looks like we have control, but we really don't have control. The operating expenses seem low due to these incomes. So that is something that you have to mention. Okay. So the next thing that we'll be looking at is ROC. So ROC shows the efficiency of an organization in using capital employed to generate operating profit. So over here, you have to understand that it is the ability of the company to use its capital employed, that is, use the company's funding to generate profit. How much is the company able to generate as profits? So if we invest in this company, whether this company can use our investment efficiently to generate more profits. That is what is the insight of this ratio. So over here, if we are making more profits, see, if our margins are high, automatically our gross profit will be high, our net profit will be high, so ROC is gonna increase. But what if we have reduced our gross profit margin to generate more sales? Then automatically your net profit margin will also be reduced and your ROC is gonna get reduced. So you have to understand that whatever affects profitability, whatever affects your gross profit ratio, whatever affects your operating profit ratio, it is going to affect your ROC. Okay. And the next thing that you can always say is that if you have invested in a new investment which is going to vest only after a year or in the coming future, then you have your part money of your funding has gone into an investment which is not yet giving returns. So it may give returns in the future. So right now your ROC will be low. It will only be high in the future because that's when your next investment is going to give you returns. Okay, so this is all about ROC. And the next thing that we have to look into is asset turnover. So in asset turnover, it shows the efficiency of the organization in using capital employed to generate sales. So the same way as we said about ROC, over here it is the ability of the company to generate sales using their capital. So they can use their capital efficiently by marketing and doing campaigns so that they can increase the sales, or they can use their capital employed for branding, whereby the company gets recognized and company's good starts getting sold on a higher rate. So all these things are something that we look into asset turnover. Now, talking about gross profit margin in asset turnover. See, if your gross profit margin is low, automatically your selling price goes low. Automatically your demand increases and your sales increases. So if your gross profit ratio is low and your asset turnover ratio is high, then over here you have to say that we have reduced our gross profit margin so we could generate more sales. So that is the reason that has to come in. So you have to first check in with your ratio whether your asset turnover ratio is high or low. If it is high, it may be due to the reason that you have made more revenue. Now check for the reasons why you have made more revenue. It may be because you have lower profit margins, or it may be because your sales department has worked very hard. So there might be some things that might be there in your scenario that point out to these uh, reasons which you can use in your answer. Okay, so let's wind up by looking into the four ratios once more. So starting with gross profit ratio. Gross profit ratio, what would we do? We would look into the gross profit margin, whether the margin is high or low. Higher the margin, it is good. Lower the margin is not always bad, because there are some times where we purposefully reduce our margins to get more sales. So in those situations, it is not bad. In all the other situations, like wherever your gross profit margin goes low due to inefficiencies, then it is bad. Your company is not performing well. So the inefficiencies could be in the production process, or it could be due to the suppliers not giving us discounts, or due to the new rates that the supplier is charging for raw materials. It could be of many reasons, or it could be due to the underlying situations like recession, or it could be due to war, or it could be due to the COVID or a pandemic, which have had a adverse effect on the market, which has reduced the margins of companies. So this can be the reason. Then coming into operating profit margin, I'll tell you, you must not focus on the margin more. Instead, you must focus on the gap of gross profit and operating profit, because that gap shows how much expenses you are incurring, how much other expenses, how much operating expenses you are incurring. And if your operating expenses are, if that gap is becoming high, if your operating expenses are increasing, that means you don't have control over your operating expenses. If it is reducing, you have control. But if it is reducing, you have control. Before saying that, check one more thing, whether you have any new other incomes, like profit from sale on discontinued operations, or profit from sale on a non-current asset. So all these things may also add up, showcasing that you have more control, but in real time you don't have that much control. So you have to check for these points also. Then coming to ROCE, in ROCE, when you're writing a ratio analysis, you can use all the points that is there in the gross profit and net profit ratio to write reasons for the ROC, because your it is PBIT by capital employed. So whatever affects gross profit and operating profit ratio is gonna affect your PBIT. So automatically it will affect the ROC ratio. And if you're not finding any uh, reasons from that which is applicable over here, then you can go with saying that you were not able to effectively utilize your capital employed, or you were effectively able to utilize your capital employed, depending on whether the ratio is low or high. Okay. And lastly, coming over to asset turnover. Asset turnover, over here we are looking at how we utilize the capital employed to generate more sales. So if whenever the asset turnover ratio is high, you have to say that it may be It is no, it is because your revenue has increased. But why is your revenue increased? It may be due to the lower margins you have charged, or it may be due to the good marketing campaigns that we have run. So if there was a marketing campaign that was run this year, and you could see that there was a marketing expense, and still your revenue has not increased, so you must talk about in the asset turnover ratio. We have made a marketing campaign, but that marketing campaign will only vest in the coming years, because you market this time, and in the same year the returns may not come. It may come in the future years. Or sometimes you have invested in marketing, and in this year itself you have got more revenue. So you have to even put up a point like this, is stating that your short term marketing was very effective, because most of the marketing are done for the next year. So if you have put in your capital into marketing and you've got results this year itself, we can say that it was a short term marketing which worked out very well. So these are the points that you have to search for. So you have to always check what is the thing that is taking this ratio up, or taking bringing this ratio down. What are the reasons behind this? And you have to find those reasons and write it in your exam. And you can write it in the same way that I'm telling you right now. So you need not elaborate it. You have to just give the major reasons. You have to write it in a short way. And I'll teach you this in the upcoming videos, whereby we'll be looking at solving a problem. Okay. So hope this was helpful. Bye. Take care.